Hey everyone, and welcome back to the channel. Today, we're diving into a really fascinating debate in the world of investing, watches versus stocks. Specifically, can that luxury timepiece on your wrist actually outperform the good old S&P 500? It's a question that blends passion with pragmatism. So let's get into it. First, let's set the stage. The S&P 500 is the benchmark for the US stock market. It's a basket of 500 of the largest publicly traded companies in America. When you invest in an S&P 500 index fund, you're essentially buying a tiny slice of corporate America. It's diversified, it's liquid, and historically, it has delivered an average annual return of around 10% over the long term. It's the tried and true path for many investors looking for steady, compound growth. It's reliable, accessible, and you don't need a loupe to inspect it. Now, let's talk about watches. We're not talking about just any watch. We're talking about high-end mechanical luxury watches from iconic brands. Think Rolex, Patek Philippe, Audemars Piguet. These aren't just tools to tell time. They are miniature works of art, marvels of engineering, and powerful status symbols. For decades, they've been seen as objects of desire, but recently they've exploded in popularity as a genuine asset class. So, how do they stack up financially? Well, the numbers can be pretty staggering. Let's take a look at some of the heavy hitters. The Rolex Daytona, particularly the stainless steel ceramic model, is a legend. When it was released, its retail price was around $12,000. Today, on the secondary market, you'd be lucky to find one for less than double or even triple that. That's an incredible return in just a few years. Another icon is the Patek Philippe Nautilus 5711. This watch was discontinued in 2021, and the market went absolutely wild. Its retail price was around $30,000, but after it was discontinued, prices on the secondary market skyrocketed to well over $100,000, sometimes even more. That's a return that would make any stock market investor's jaw drop. And it's not just those two models. Certain Audemars, Piguet Royal Oaks, vintage Rolex Submariners, and limited edition pieces from various brands have all shown similar, if not more dramatic, price appreciation. So, case closed. Right. Watches are the better investment. Well, not so fast. It's a lot more complicated than that. The first major difference is what drives the value. The value of the S&P 500 is driven by the collective earnings, innovation, and economic growth of the 500 companies within it. It's based on fundamental economic principles. The value of a luxury watch, on the other hand, is driven primarily by supply and demand, brand prestige, rarity, and sentiment. It's a market heavily influenced by hype, trends, and the psychology of collectors. This makes it inherently more speculative and volatile. Let's talk about the risks. With the S&P 500, your biggest risk is a broad market downturn or a recession. While these happen, the market has historically always recovered and reached new highs. Your investment is also highly liquid. You can sell your S&P 500 shares on any business day and have cash in your account within a couple of days. Investing in watches is a completely different ballgame. First, there's the issue of authenticity. The market for fakes or superclones is incredibly sophisticated. Buying from an untrusted source could mean you end up with a worthless piece of metal. You need significant expertise or a highly trusted dealer to navigate this. Then there's condition, a scratch, a ding, a replaced part that isn't original. All of these can dramatically reduce a watch's value. You also have to factor in the cost of maintenance. A high-end mechanical watch needs servicing every 5 to 10 years, and that can cost hundreds or even thousands of dollars. It's like a car, it needs upkeep. And what about liquidity? Selling a $100,000 watch isn't as simple as clicking a button. You need to find a buyer willing to pay your price. This can take time, and you'll likely have to pay a significant commission to a dealer or an auction house, often ranging from 10% to 25%. Compare that to the virtually non-existent transaction fees for selling an index fund. Another crucial point is dividends. Many companies in the S&P 500 pay dividends, which is a portion of their profits paid out to shareholders. You can reinvest these dividends to buy more shares, creating a powerful compounding effect. Your watch, on the other hand, sits in a box or on your wrist. It doesn't generate any income. Its entire return is based on price appreciation, which is never guaranteed. So let's re-examine those amazing returns. While certain models have performed spectacularly, they are the exception, not the rule. For every Patek Nautilus that triples in value, there are countless other luxury watches that have barely kept up with inflation or have even lost value. Picking the winners requires deep knowledge, a bit of luck, and often the ability to buy these watches at retail, which is a huge challenge in itself. Most of the sought-after models have waitlists that are years long, if you can even get on them. This means most people have to buy on the secondary market, where the premium is already priced in, limiting your potential upside. The watch market also goes through cycles. We saw a massive boom in 2021 and early 2022, fueled by low interest rates and a surge in disposable income. But since then, prices for many popular models have cooled off and corrected significantly from their peaks. This shows that, just like any other market driven by speculation, what goes up can certainly come down. The S&P 500 also has downturns, but it's backed by the real economy. The watch market is backed by what a small group of wealthy individuals is willing to pay. So, what's the verdict? Should you sell all your stocks and buy a box full of Rolexes? Absolutely not. For the vast majority of people, the S&P 500 is a far more sensible, reliable, and accessible way to build long-term wealth. It's diversified, liquid, and requires far less specialized knowledge. But that doesn't mean watches have no place. The best way to think about a luxury watch is as a passion asset. If you genuinely love horology, appreciate the craftsmanship, and enjoy wearing the piece, then any financial appreciation is a fantastic bonus. It's an asset you can use and enjoy. You can't exactly wear your stock portfolio to dinner. If you decide to venture into watch collecting as an investment, treat it like you would any other higher-risk speculative asset. It should only be a very small part of a well-diversified portfolio. Do your homework, understand the risks, and most importantly, buy what you love. If the market turns and the value drops, you'll still have a beautiful timepiece that brings you joy. If you buy a watch purely for financial gain and it loses value, you'll be left with nothing but disappointment. In conclusion, while the headline-grabbing returns of certain watches are undeniably alluring, the S&P 500 remains the champion for consistent, long-term wealth creation. Watches are a fascinating, enjoyable, and potentially profitable collectible, but they are not a substitute for a sound investment strategy. They are a luxury good first, and an investment a distant second. The thrill of the hunt and the pride of ownership are the real dividends. What do you think? Are you a watch investor, or do you stick to the stock market? Let me know your thoughts in the comments below. I'd love to hear your experiences. If you enjoyed this video, please give it a thumbs up and subscribe for more content. Thanks for watching, and I'll see you in the next one.